Dan Ives just made a bold prediction on CNBC Squawk Box Asia. He says Nvidia could become a $6 trillion giant by 2027. As the global head of tech research at Wedbush, he also believes the recent software sell-off is completely disconnected, and that software remains the heart and lungs of the AI revolution with much more upside ahead. In this video, I'm going to show you his interview, break down exactly what he meant, and give you my own take on it. Then we'll dive into 5 of the best military AI stocks to watch in 2026. Make sure you like the video, share it, drop your thoughts in the comments, and subscribe so you don't miss future investing updates. Now let's hear what Dan Ives had to say.
Before we get to that 1 trillion number, right, the price reaction used to be Nvidia beats and the stock jumps. We're starting to get used to this, right? Maybe the second or third time it's happened. Nvidia beats, it jumps, and then it fades. What's going on here?
Yeah, look, I mean, Martin, it's really a victim of their own success. I think the bar continues to be set higher and higher. But the reality is this is just a digestion period. I think as you look out to the coming years, I think this is just the start. It's year 3 of an 8 to 10 year build out. And there's one chip in the world fueling the AI revolution, and that's Nvidia. And I think we saw that front and center at GTC today.
Is this not, though, as some people are saying, it used to be pricing in optimism. Now investors in the market, they're demanding proof.
Yeah, look, I think to some extent, look, right now, New York City cab drivers bearish in tech. So I think that's part of it, and you see with Microsoft, the hyperscalers, and others. I think for NVIDIA, yeah, it's a prove it, but ultimately I think there's still some concerns about competition when you think about Google, OpenAI, and others. But as we talk about, when it comes to inference and the Grok deal, we're talking about a $3 to $4 trillion market opportunity. And I think that continues to be why you own NVIDIA. I think this is a $6 trillion market cap by 2027.
Ooh, okay, Dan, listen, I want to focus in on that $1 trillion number that Jensen has been throwing around. When I think back and try and put it in context, Amazon and Walmart, it took Walmart decades to hit $1 trillion. It took Amazon probably an entire lifetime, and then now Jensen is saying they're going to hit it in, 2 years or so? And the other thing is I did some simple math, and you live and breathe these numbers. I just wake up, slam an espresso, and then start catching up on my phone. So you're probably better at than I am.
You're modest. Come on.
2025, $216 billion in revenue, $364 billion for 2026 this year. Next year, 2027, is $470 billion. So you add that up, that adds up to $1.05 trillion. I'm not niggling here because at these levels, I mean, every decimal point makes a difference. So it sounds as though, is he guiding lower?
No, I think, look, he's just talking about the backlog that he sees in the 2027. But my view is, as we've seen the last few quarters, he continued to really sandbag to some extent 20-30%. That's probably going to be higher than these numbers. So when you look at the trillion, that's probably closer to 1.4, 1.5 trillion when it's all said and done. And I think that continues to be the formula because they're seeing demand, to put it in context, 12 to 1 demand to supply right now for NVIDIA chips.
And of course, SK Hynix surged 7% in yesterday's session in the lead up to this GTC event. What we got, I think the big takeaway is obviously NVIDIA continues to expand in this business. They are a platform. They are set to ride sort of multiple waves of AI. I get that. And that's been your mantra, Dan. But I wonder if memory layers will provide better investment opportunities than NVIDIA's of the world, just because the competition story is there. And of course, there are some question marks over what Google is doing, what some of the other hyperscalers are trying to achieve here to bring down the cost and bring up their sort of vertical integration story.
Look, you hit the nail on the head. I think that's really why this has sort of been on a treadmill in terms of NVIDIA stock. Look, when you look at memory, we're in a memory super cycle. From Micron to SK, and obviously what we see, really across the board in terms on the memory side, SanDisk among others. Look, those stocks are going to continue to go higher. But my whole point is that when you look at what's happened with Nvidia, there's only one godfather of AI. And even if you look at what's happening on the demand side, when you look at Rubin and you go down the path, they're going to continue to have demand to supply 10 to 1, 12 to 1, probably for the foreseeable future. But that's also going to be a benefit to Google. But it speaks to our view. You have to own the second, third, fourth derivatives. You talk about memory, you talk about chips, and I continue to think the software sell-off is the most disconnected sell-off that we've seen since covering stocks in the late 90s.
How are you thinking about the whole software angle? And of course, we've had a lot of opportunities on CNBC to hear from you and to get your views. And then the latest that we got just overnight was Nvidia software is aiming to bring OpenClaw to the enterprise. What does that say to the whole software space? Is that a negative to Microsoft's of the world?
Look, I view it ultimately as a positive because it just speaks to and what Jensen's saying is that the use cases are going to be in software. That's where everyone's going after. There's a better chance of me being the Olympics in 2028 than Anthropic unseating a Salesforce, a ServiceNow, a CrowdStrike, a Palo Alto. I think right now, that's why it's an AI ghost trade. But it continues. I think software, you've seen the bottoming, and I think it's very important because as these use cases play out second half of the year, software will be the hearts and lungs of this AI revolution, along with memory, along with chips. But it speaks to our view. This is still a bull cycle for tech, despite obviously this white knuckle period that we're going through.
The first thing that really stands out in this interview is how the market is reacting to Nvidia earnings now compared to before. The interviewer points out something subtle but extremely important. Nvidia beats expectations, the stock jumps, and then it fades. That pattern has started to repeat. And this is where Dan Ives gives a very telling explanation. He calls it a victim of its own success. And I actually agree with that, but I think there's an even deeper layer to it. When a company dominates so hard, expectations stop being about beating estimates and start becoming about exceeding perfection. Investors are no longer impressed by great results. They expect extraordinary results every single time. So what we're seeing is not weakness in Nvidia's business. It's the market struggling to keep up with how fast the company is executing. Dan Ives frames this as a digestion period, and that's a key phrase, because what he's really saying is that the market is pausing, not because the story is broken, but because it has run so far so fast that it needs time to reset expectations. And then he zooms out to what I think is the most important part of this entire conversation. He says we are only in year 3 of an 8 to 10 year AI build-out. That right there is the entire thesis. Because if that's true, then everything we're seeing right now is still early. And I think this is where most retail investors make a mistake. They look at Nvidia's massive run and assume they've missed it. But if this really is the third inning of a 10-inning game, then the biggest gains across the entire ecosystem might still be ahead. Now he makes a very bold statement. He says there is only one chip in the world fueling the AI revolution, and that's Nvidia. That's a strong claim, but in the current landscape, it's not far off. Nvidia has become the backbone of AI infrastructure. Their GPUs are essentially the picks and shovels of this entire gold rush, and when you control the infrastructure layer of a technological revolution, you capture an outsized share of value. But then the conversation shifts into something even more interesting, the idea that investors are now demanding proof. And this is where sentiment really comes into play. Dan Ives says even the New York City cab driver is bearish on tech right now. That's his way of saying that the narrative has shifted from blind optimism to skepticism. And historically, that's actually where some of the best opportunities are created. Because markets tend to overshoot in both directions. First they overprice the future, then they start doubting it too early. And right now it feels like we're entering that second phase where investors are saying, show me. Now, I think this is healthy. Because when a market transitions from hype to proof, the strongest companies separate themselves from the rest. And Nvidia, based on everything we're seeing, continues to deliver. Then Dan Ives drops one of the biggest numbers in the entire interview. He talks about a $3 to $4 trillion AI market opportunity tied to inference. This is where things get really interesting because most people focus on training AI models, which is what drove Nvidia's initial surge. But inference, which is actually using those models in real-world applications, is where the long-term value gets unlocked. Think about it like this: training is building the engine. Inference is putting that engine into millions of cars. And that's where the scale becomes exponential. Now, when he says Nvidia could reach a $6 trillion market cap by 2027, that sounds insane at first. But if you actually follow the logic, it starts to make more sense. If AI becomes as foundational as electricity or the internet, then the companies controlling that infrastructure will command enormous valuations. Still, I'll give you my honest take here. 6 trillion is possible, but it assumes Nvidia maintains dominance without major disruption, and that's where I think investors need to stay grounded. Because competition is coming, whether it's Google, OpenAI, or custom silicon from hyperscalers, the landscape will evolve. That doesn't kill Nvidia's story, but it does mean the path won't be a straight line. Then the conversation moves into that $1 trillion revenue number that Jensen Huang has been hinting at. And this part is fascinating because they start breaking down the math. You've got projections of over $1 trillion in cumulative revenue over a few years, and Dan Ives basically says those numbers might even be conservative. He suggests Nvidia has been sandbagging guidance by 20 to 30%. And this is something we've actually seen before with elite companies. They underpromise and overdeliver. If that's true, then the 1 trillion number could actually be closer to 1.4 or 1.5 trillion. But what really stood out to me was the supply-demand imbalance he mentioned. 12 to 1 demand versus supply for Nvidia chips. That's not just strong demand, that's extreme scarcity. And whenever you have that kind of imbalance, pricing power becomes enormous. Nvidia is not just selling chips, they are controlling access to AI capability, and that gives them leverage that very few companies in history have had. Now, the interviewer brings up a really important counterpoint. Maybe the better investment isn't Nvidia itself, but the surrounding ecosystem, especially memory companies. And this is where Dan Ives actually expands the thesis in a way that I think a lot of people miss. He talks about a memory supercycle, and I completely agree with this angle, because every AI model, every data center, every inference workload requires massive amounts of memory. So while Nvidia builds the brain, memory companies are essentially providing the fuel that keeps everything running. This is where the concept of second and third derivatives comes in, and this is something I think more investors need to understand. The biggest returns in a megatrend don't always come from the obvious leader. Sometimes they come from the companies supplying the ecosystem around that leader. So while Nvidia might be the face of AI, companies in memory, networking, and infrastructure could quietly deliver massive upside. Then we get into the software discussion, and this is where the conversation becomes even more forward-looking. Dan Ives calls the recent software sell-off one of the most disconnected moves he's seen in decades. That's a strong statement. And what he's implying is that the market is underestimating how much value AI will eventually create in software. Because at the end of the day, hardware enables AI, but software monetizes it. And this is where I think he's absolutely right. The real money in AI will be made when these capabilities are integrated into everyday business processes. Automation, decision-making, cybersecurity, enterprise workflows. That's where AI becomes indispensable. He even goes as far as saying, software will be the heart and lungs of the AI revolution. And I like that analogy because it captures the idea that hardware is the foundation, but software is what brings everything to life. Now, he also dismisses the idea that newer AI players will dethrone established software giants like Salesforce or ServiceNow anytime soon. And I agree with that as well, because distribution matters. These companies already have deep relationships with enterprises, massive datasets, and integrated platforms. So even if new AI startups emerge, they will likely partner with or be absorbed into these ecosystems rather than replace them. So when you zoom out and look at the entire interview, the core message becomes very clear. This is not just about Nvidia. This is about an entire AI stack that includes chips, memory, infrastructure, and software, all moving together in what could be one of the largest technology cycles we've ever seen. And despite the volatility, despite the skepticism, despite the so-called white-knuckle period he mentions, Dan Ives is making one thing very clear. He believes this is still a bull market for tech. Now, my personal take is this. I think he's directionally right, but timing is everything. We are likely going to see continued volatility. Stocks will surge, pull back, and test investor conviction over and over again. But if the underlying thesis plays out, the long-term trajectory is still up. So the real question for investors isn't whether AI will be big, it's how you position yourself across the ecosystem to capture that growth without getting shaken out during the inevitable swings. Because if this really is an 8 to 10 year cycle, then what we're watching right now is just the beginning of something much bigger. Now let me show you 5 military AI stocks that are quietly positioning themselves at the center of the next global arms race, where artificial intelligence is becoming the most valuable weapon on the planet. Let's start with the first company. Palantir Technologies, ticker symbol PLTR, is one of the most important software companies in modern defense infrastructure, and I would argue it is the closest thing we have today to a pure play on military AI at scale. What makes Palantir so unique is that it does not build weapons, it builds decision-making systems. And in modern warfare, information is power. The ability to process massive amounts of data, identify patterns, and deliver actionable intelligence in real time is becoming more valuable than traditional firepower. Palantir's core platforms, Gotham and Foundry, are designed to integrate and analyze complex datasets across intelligence agencies, military operations, and defense contractors. This allows governments to make faster and more accurate decisions, whether that's tracking threats, coordinating missions, or optimizing logistics. And this is where the moat becomes very clear. Palantir is deeply embedded within government agencies. Once their software is integrated into mission-critical systems, it becomes extremely difficult to replace. The switching costs are massive, both financially and operationally. This creates a level of stickiness that most software companies can only dream of. Now, when you look at the growth drivers, they are directly tied to the future of warfare. As militaries invest more in AI, data analytics, and autonomous systems, the need for platforms like Palantir only increases. Financially, Palantir has been showing strong momentum, especially on the government side of the business. Government revenue continues to grow as contracts expand, and the company has also been improving profitability, which was a major concern in earlier years. Another important factor is their expansion into commercial AI. While defense remains a core segment, their ability to scale AI solutions into private sector industries gives them an additional growth lever that many defense-focused companies do not have. In my opinion, Palantir represents the software layer of the military AI stack. If Nvidia is building the infrastructure and chips, Palantir is building the brain that interprets and uses that data. And in a world where data-driven warfare becomes the norm, that position is incredibly valuable. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the second company, and this is where we shift from software into physical defense systems. Lockheed Martin, ticker symbol LMT, is one of the most dominant defense contractors in the world, and what makes it especially relevant today is how it is integrating artificial intelligence into its defense systems. Lockheed does not just build equipment, it builds advanced systems that operate at the highest level of complexity, and this is where AI becomes critical. Modern defense platforms generate enormous amounts of data through sensors, radar systems, and communication networks. AI is used to process that data, enhance targeting accuracy, improve decision-making, and enable greater levels of autonomy. So when you think about Lockheed, you are not just thinking about traditional defense hardware, you are thinking about intelligent systems that are becoming more capable over time. The company's competitive advantage is built on scale, expertise, and long-standing government relationships. Winning major defense contracts is not easy. It requires years of experience, deep technical knowledge, and a track record of delivering reliable systems. Lockheed has all of that, and once these systems are deployed, they tend to stay in use for decades, supported by long-term contracts for maintenance, upgrades, and integration. That creates predictable revenue and strong cash flow. From a financial perspective, Lockheed Martin is known for its stability and strong cash flows. Defense spending tends to be resilient, even during economic downturns, because national security is not optional. This makes Lockheed a different kind of investment compared to high-growth tech stocks. It offers a balance of steady income and long-term exposure to one of the most important technological shifts in defense. In my view, Lockheed represents the hardware backbone of military AI. It is where advanced technology meets real-world deployment. And as governments continue to modernize their defense capabilities, companies like Lockheed will remain at the center of that transformation. Now let's move to the third company, which takes this idea of advanced defense systems even further. Northrop Grumman, ticker symbol NOC, is a company that operates at the cutting edge of military technology, and it plays a critical role in shaping the future of AI-driven warfare. What makes Northrop unique is its focus on advanced systems that go beyond traditional defense. We are talking about autonomous platforms, stealth technology, and space-based defense capabilities. And all of these areas rely heavily on artificial intelligence. Let's start with autonomous systems. Unmanned vehicles and drones are becoming increasingly important in modern warfare. These systems need to operate in complex environments, make decisions in real time, and adapt to changing conditions. That requires advanced AI. Northrop has been investing heavily in this space, developing systems that can operate with minimal human intervention while maintaining high levels of precision and reliability. Now add in space. Space is becoming a critical domain for national security. Satellite systems, missile warning systems, and communications infrastructure all play a vital role in defense. Northrop is deeply involved in these areas, and AI is a key component in managing and optimizing these systems. This gives the company exposure to one of the most important long-term trends in defense. From a financial perspective, Northrop benefits from a strong backlog of contracts. This provides visibility into future revenue and supports long-term planning. And just like with Lockheed, the barriers to entry are extremely high. These are not markets where new competitors can easily emerge. The level of expertise, capital, and trust required to compete is enormous. In my opinion, Northrop represents the innovation layer of military AI. It is focused on the technologies that will define the next generation of warfare, particularly in areas like autonomy and space. Now let's move to the fourth company, RTX Corporation. Ticker symbol RTX is a company that plays a crucial role in connecting different elements of modern defense systems. What makes RTX so important is its focus on integration. Modern warfare is not about isolated systems. It is about how different technologies work together. Missiles, radar, sensors, and communication networks all need to operate as a unified system, and this is where AI becomes essential. RTX is developing advanced systems that use artificial intelligence to improve targeting accuracy, enhance threat detection, and optimize performance in real time. For example, AI-powered radar systems can track multiple targets simultaneously and adapt to changing conditions. Missile defense systems can use AI to improve interception accuracy and response times. These capabilities are becoming increasingly important as threats become more complex. From a financial standpoint, RTX benefits from a diversified business model that includes both defense and aerospace. This provides multiple revenue streams and adds a layer of stability. In my view, RTX represents the integration layer of military AI. It ensures that all the different components of modern defense systems can work together effectively, and as warfare becomes more interconnected, that role becomes even more valuable. Now let's move to the fifth and final company. Leidos Holdings, ticker symbol LDOS, is one of the most important players in the implementation and infrastructure side of military AI. And this is a part of the ecosystem that many investors overlook, because here is the reality. Building advanced technology is only part of the equation. The real challenge is implementing it at scale within complex government systems. That is what Leidos specializes in. The company focuses on integrating technology into real-world operations, including cybersecurity, data analytics, and IT modernization. These are all essential components of military AI. AI systems require secure networks, reliable data pipelines, and seamless integration across different platforms. Without that infrastructure, even the most advanced systems cannot function effectively. Leidos has built strong relationships with government agencies, and its expertise in this area makes it a trusted partner for large-scale projects. That creates recurring revenue and long-term contract visibility. Another key factor is cybersecurity. As military systems become more connected, the risk of cyber threats increases. Protecting these systems is critical, and Leidos has strong capabilities in this area. From a financial perspective, Leidos offers steady growth and consistent revenue, supported by government contracts. It may not have the same growth profile as a pure software company, but it provides stability and exposure to the long-term expansion of military AI. In my view, Leidos represents the execution layer of this entire ecosystem. It ensures that all the advanced technologies we have discussed can actually function in real-world environments. Now let's zoom out and connect everything. What we are seeing is a full-stack transformation of defense. Palantir represents intelligence and data. Lockheed represents deployment of advanced systems. Northrop represents innovation and future technologies. RTX represents integration. Leidos represents execution and infrastructure. This is not just a trend. This is a long-term shift driven by rising geopolitical tensions, increasing defense budgets, and the growing importance of artificial intelligence in national security. And in my opinion, this is one of the most powerful investment themes of the next decade. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to ask you something. Which part of the military AI stack do you believe has the strongest long-term advantage? Is it the data and software layer, the hardware and deployment layer, or the integration and infrastructure layer? Drop your answer in the comments. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.